Eric Mwather with Mwather.com. In response to your question, I'm going to begin by taking a look at the 50 level question. So the question was the fact that Apple was moving below 50 yesterday, and we see that that was good for a relatively big down day, which was 2% as it moved below 50. And so the question is, now that it's moving below 50, what next? And I need to clarify something here because maybe I haven't explained it properly, and I think I do confuse people whenever I talk about the 50. But this activity is just for the day. I know it's a little bit confusing, but it's just for the day when it happens. As you can see, this is yesterday's action. It moves below 50, expect a big down pullback, maybe not a good day to go long the stock. Maybe you can go long the stock at the close if other parameters make sense to you. So this move below and above 50 can eventually lead to the market breaking down. So let's keep that in mind. So yes, it's significant, but not necessarily. It's just something that tells you what's going on the daily. Now, if maybe it was close to the 50, if it was close to the 50 also on the weekly RSI, or close to the monthly 50 level here, then those three parameters would mean maybe that the move is going to be longer. And I'll show you one example is the Dow. Is it the Dow? Let's take a look at the Dow here. I'll show you something pretty cool. Okay, so this is the Dow. We've seen the Dow go up 3 days ago, go down 3 days ago as it moved below 50. We saw the Dow jump up for a big relative size day when it moved back above 50, and then yesterday we see the Dow plunge 300 points here because it moved back below the 50. So the 50 level has seen the Dow move below it for a big down day, back above it the next day for a big up day, and yesterday down below that 50 level for a big down day. So on the days it was moving above or below 50, you get the sense of the general direction. Does it change the trend, or does it mean that the trend has begun? No. But the Dow could end up staging a trend, and the trend could be that because it's very close to the 50 on the weekly, if it moves back below 50 this week, expect an increment to the downside into the close of the week. I hope that makes sense. For example, you can see this 3-week drop here, which is a trend or a swing trade, corresponds with this break below 50, this weekly break below 50. And then there's the reversal, which is when the market moved above here, upswing, as the Dow recaptured the 50 level. So the bigger time frame, when they move above or below 50, expect a swing trade in that direction. But on the dailies, the hourlies, and the minute charts, when the Dow or the markets move above or below 50, it's just for that session, that hour, that minute, where you get a slight move, extended move down or up. And here, as an explanation into your question about trends, how long can a trend be? And I think the answer there is an unknown, because you can see here there was a 1 week close below 50, and then on the very subsequent week or weeks, the market recaptured the level back above 50. So I don't think there is any minimum number of days that the market has to be down or up for there to be a new trend. Generally speaking, and I know this is not the best answer, I would have to default to the weekly, and I'll show you a simple way to determine trend. Let's take a look at the Dow. No, that's too much. We could use this. Let me go back 4 years maybe. So on the question of trend, and it's a tough one because a trend can be good for 2 weeks or 2 days or 2 minutes and change. Markets can change their mind even after confirmation that there's a trend. So I believe there is no correct answer, because a trend is a trend until it's no longer a trend. And so it's a gray area. But generally speaking, and this is generally speaking, on the weekly, if you take a look at the 13-week moving average as an example, 13-week moving average, and we are going to take the exponential moving averages, and then also couple that with the 34-week moving average, again exponential, so we can quicken this activity here. So whenever you have a crossover with the 34-week moving average crossing above 13-week moving average, so the 13-week moving average is in green and our blue is gonna be the 34. So whenever you have crossover of the 13 above the 34-week moving average, that tends to be beginning of a bull market, or at least a bull trend. Just like you can see here, there was a crossover between the 13-week moving average moving above the 34-week moving average, and since that late 2011 we've seen the market has not given us the opposite, and the opposite would be this time we're going to take it this way. And bear with me, I'm trying to decide in my head which colors to use. Alright, we're going to change. So the 13-week moving average is going to be in red. 13-week moving average undercuts the 34-week moving average. So this is 34, and the other color here is 13-week moving average. So whenever you get that crossover to the bearish side, then a new trend has begun, and this time it's going to be a bear trend. Generally speaking, that's one way of doing it. The 13 crossing above or below the 34 determines the direction of the market, generally speaking. And if we take a look at, let's take a look at a market, that Brazilian market, which has been struggling, and we can see that the Brazilian market had a bearish crossover with the 13-week moving average moving below the 34-week moving average. And since then, which is somewhere here, you've seen this market plunge. There was a bullish crossover here for a weekly trend, and that trend kept the market higher for a couple of weeks. And so that's generally one way to tell direction. Is it the best? Not necessarily. But is it reliable? Yeah, it can give you a feel or a sense of where the direction is going. And if you really want to confuse yourself a little bit more, is if you want to do it, you can also take a look at the daily. And on the daily, you can also consider the same. And on the daily, you can also use the crossover between the 13-day moving average again exponential if you want to keep it, so we can try and capture the recent moves in the market crossing over the 34-day moving average, again exponential. If this crossover is taking place with the 13 moving above the 34, that's bullish, of course. And if you get the opposite, which is the 13 undercutting the 34-week moving average, that tends to be bearish. So that's generally another way of telling market direction. Is it the best or the most accurate? Not really. Nothing really is, because markets can change their mind, but at least it gives you a sense of where things are tending to go over a period of time. In fact, if you take a look at the EWZ with only the 13-week moving average and the 34-week moving average, you can see that there was a bearish crossover on the daily here, and since then we've seen this drop in the Brazilian market. So there's your trend based on the crossover, which was bearish at least the most recent crossover. And you can see there were instances here where there was other crossovers on the way up. Again, not the best, but they were successful. Even this crossover here did indicate markets were moving higher, but this one here turned bearish. We take a look at another, which is the USO, which in my opinion, this is a crash, this steep drop. And you can see that there was a bearish crossover here at about 39, which would be at about 100 on the crude oil. So this is a big drop, and crude oil is trading here at about 48, 49. So relatively speaking, that to me is a huge drop in a couple of months. But you can see here we've seen a short crossover here in the daily, but yet the market hasn't moved anywhere. That's between the 13-day moving average and the 34-day moving average. So maybe you can just set an alert for it to break out above this declining line. Maybe that is when there'll be another crossover between the 13 and the 34 that would be successful. So there you have it. Sometimes the crossovers are not great, and the reason is markets have tendency of changing their minds. We go back to Apple and we're taking a look at the daily. We see that a couple of crossovers, as you can see here, which was bullish, crossover here which was bullish, is a bearish crossover here, but the market didn't go down, it was sideways, and then you get a bullish crossover here. So that's one way you can use the 13-day and the 34-day. We go back to Apple on a weekly chart because you have to combine all time frames to get a sense of a trend, and here was a bullish crossover. Since then we haven't seen a bearish crossover. So using that principle, you can see that the market is generally strong in terms of Apple, and so that would be one way to use the trend line. And if we take a look at one more, and sorry for digressing, but this is Tesla, and you can see here, in fact let's go about 3 years worth of data, or 2.5. We can see there was a bullish crossover on the weekly between the 13 and the 34-week moving average, which was bullish, and obviously we've had this massive move, and now we are looking at the exact opposite, which is from a trend reading perspective, this indicates momentum has shifted to the downside. So that's one way you can tell trends. And just to answer your question, go back to your question, is how many days does a stock or an instrument have to move before you can determine that there's a new trend? And I have to say, I don't think there's an answer for that. There's no answer, because just because it's been down for 5 days in a row doesn't mean that the trend is gonna be down. It could be the end of the trend and now it's gonna go up. Or just because it's been down 2 weeks doesn't mean that now it has to go down. There's no answer to the minimum requirement for a trend. Trends take place as they want, and just the key is to make sure you understand what the charts are doing, and maybe you can determine the trend based on the overall analysis, based on what the weekly, the monthly, the daily, and the hourlies are doing. You can combine all those time frames and indicators to get a sense of where the market is going in terms of a trend or a trend reversal. So there's no minimum number of days for you to confirm that this is a trend I have to be in. It's just what the charts look like that should determine your next move, your next play. So let's go back to Apple. Take a look at the weekly here. Go back to the daily chart, which was the beginning of your, or the main aspect of your question was this trend line. Now, the one thing I was going to note is on your charts, the ones you sent me, you are using a 6 months daily. And I think there's nothing wrong with this, using a 6 month daily, but I think by using a 6 month daily, you are giving away a lot of, or missing a lot of information, in my opinion. I think a 1 year daily gives you a little bit of a feel for what's going on. 6 months a little bit too narrow. But you are drawn a line that looked something like that and asked whether it was correct. I wouldn't say it's wrong or correct, you know what I mean? You can draw your lines whichever way you want, and you can actually draw these lines this way if you want, if there's a reason, if you're looking for something, because it connects this low. There's uniform activity below the line, above the line here, also uniform activity above the line, below the line there. It touches that line or that low and this node there, so you can draw it that way. There's nothing wrong with that. And let me just explain here, because it looks something like this, which is this low. It comes here with uniform activity, again uniform activity, and then it touches this, and eventually there's a small node here before it breaks. So I've basically redrawn this. Hope that makes sense. There, you can draw this through these two lows, through them, and I mean through, because of the uniform activity below the line, back above it, which means you can do that. In other words, this is so uniform that you can take this as balancing out, and so you can do that. Hope that makes sense. But I think for the line, in my opinion, you probably want to draw it connecting the lows like that. And you can see this is where the stock has come as of right now. And your question was, do we draw it here if you're trying to catch the bounce and see whether it holds? If it holds there, maybe you can take a position. I say that makes sense because this line is legit. It's legit because it connects 3 points, 1, 2, 3. So it's a well-established line by the market, so you can respect it. The one thing I was going to try and emphasize is for you to use the 1-year dailies, because you can see that off this low here, the stock hasn't been back here since then. We've seen this nice move in the market, so we know the move began here. So always find your line. Your uniformity line should have a point of reference. The uniformity line is not to be drawn connecting the lows like that, even though it would make sense. In this particular example, it would make sense. But the uniformity line should not be drawn connecting the lows, and here it connects the lows here, 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 and here, so it makes sense. But your uniformity line should have a powerful origin, and the origin is this lows and a move higher. So the uniformity line should have a strong basis for being drawn. And so we can see that if we draw our line here, this entry, and a simple straight line coming off that, which happens to be close to the low. So on this particular example, it is close to the low or the lows. And you can see ever since then the market's been using this for short-term bounce in the stock. Uniform activity below the line, back above it. There was a low there, and since then it's been bouncing on this line and holding, and then finally moving high. So the question was, so let me draw this again. So the question is, this uniformity line or this support line, which one should be used? And actually it's a very simple answer. It's a good question with a simple answer. And the simple answer is you use the line where the market responds to first. So if the market bounces on this line here first, that's the one you use. If the market doesn't bounce on this and comes and bounces on the green line, then that's the one you use. Use the lines or the line that the market is showing it is responding to. So whichever comes first, you take that trade. Now there's some other information here that I need to mention, and it is this nice move in the stock recently. And this move began here, and that corresponds to this RSI movement here. So you can see all this is 1 point here. So hope that makes sense. So this is showing you where the movement in price began and where the movement in the RSI began. So we draw a simple straight line like that. So not only do we have this line connecting the lows, we also have another uniformity line, and this uniformity line is the one that gave us the most recent move. So the market is coming back to test the psychology of this recent move, and those two lines intersect at exactly where the stock is trading right now on the daily RSI. So if you see that it is bouncing off these two lines, indication there could be that on a day-to-day basis the stock wants to bounce. If those two lines don't hold, your last line of defense is the uniformity line that we drew earlier here based on this entry point here. So you got a couple of lines there to consider. The one the market responds to first is the one that you take, because that could be your last chance to buy it while it's on a pullback mode. I hope that makes sense. So I trust I answered the main aspects of your question, and let me know. Eric Mwathe, good luck, peace, and blessings. I am out. Woo!